And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Is China still investable? Regulatory risk rising fast. Risk from both China regulators seeking to rein in everything from tech to education to food delivery services, and U.S. regulators like SEC Chair Gary Gensler, who is now calling for more disclosure from Chinese firms regarding their ownership structure. After a decade where investors have increased exposure to China, many are now debating whether China should be considered a separate asset class from the U.S. and indeed from the rest of the world. Joining us to discuss is Kevin Carter, who runs the Emerging Market Internet and Commerce ETF. The symbol is EMQQ. They invest heavily in the Chinese consumer. Perth Toll is the founder of Freedom 100 Emerging Market ETF. The symbol is FRDM. That weights exposure to emerging market equities based on personal and economic freedom metrics. And my old friend John Davi from Astoria Advisors, which uses ETFs to allocate investments all over the world. All right, Kevin, you've told me repeatedly, stay focused on the emerging market consumer. What's the broad thesis behind EMQQ, and why do we need to keep staying focused, not just on China's emerging market consumer, but on emerging market consumers all over the world?
Sure. Well, when you really break down emerging markets, the thing that's emerging are the people. You've got billions of people, 85% of the world's people. 90% of the world's people under the age of 30. So emerging markets are both the world and even more of the future. And the people are moving on up, and they want stuff. They want more and better food, clothing, appliances, entertainment. They want their kids to go to college, and they want a car. And that's the story. It's well documented. And it's what everybody should be focused on in emerging markets. But what makes the story even more exciting is that all of those billions of consumers are getting two things that we take for granted. First, they're getting a computer for the first time. It's not on their desk, it's in their pocket, and it doesn't have an Apple logo. It's
a smartphone.
A smartphone, a supercomputer that's in their pocket, and it's running on Android, and it costs $50, $60, $80, and getting better and more affordable every year. And it's also bringing with it the third mega trend, which is the internet, something I've had since 1995, first on a telephone line in the Marina District of San Francisco. Now the internet shows up in my pocket. But the reality is most of the world was never wired. So all of those billions of people getting their first computer, their first internet access, and importantly, because they don't have a bank account with a debit card, they don't have a cable television on the wall, and there's not a Target store, they're leapfrogging to digitized consumption and are in many ways more digital than we are.
So it's pretty simple. The consumer plus a smartphone plus the internet equals massive revenue growth. Let me just turn to Perth. What's wrong with this equation? Perth, Kevin's saying stay focused on the consumer and private companies, but you keep telling me there's no distinction anymore. The state-owned enterprises, private enterprises in China, they're all the same. Or are they all owned or controlled by the Chinese government at this point?
Yeah, I think let's be clear here. I think in the emerging markets, in general, I agree with Kevin that the emerging market consumer is a powerful place to be. But I want to focus where the consumer is free and where companies are free to act in their own best interest and their shareholders' best interest instead of the interest of the state. In China, for example, that's not the case. And every company has to answer to the state. And we've seen that recently with the actions in education tech, in Alibaba, in Meituan, in JD, and the list goes on and on.
And so I think in China, especially, we need to be careful in that, okay, there are
1.4 billion people, but until those people can be free to have as many children as they have control over their own lives, and where companies can have control over how they run their business, it's not a place that's investable right now.
Yeah, and obviously we're having a little problem with the sound there. I wonder if we can work on that. But I want to turn to you, John, here. You invest all over the world. Well, where do you stand on China? You've repeatedly sort of been non-ideological on China and talk about it more as a value play. Is that the right way to look at it? Don't worry about the ideology and when to get in and when to get out?
I think so, Bob. And I've always told our investors, like, China's a long-term play. There's going to be a lot of bumps in the road. It's very volatile. So we have a strategic overweight to China. We've had it. I've been on this show many times. I've liked China. I think what we're seeing now is par for the course. There's always regulatory risk invested in China. I think right now, there's value in there. I think there's more downside, but I think long-term for everything that Kevin talked about, there's a way to monetize these billions of people in broad emerging markets, and China is a good way. China has had low correlations to the U.S. The last month, U.S. has been rallying, China's been going down. That's good when you own a globally diversified portfolio of stocks.
But there's always been regulatory risk, but what we've seen recently is upping the ante. I mean, this is more than just normal. The Chinese government has been going after a number of industries. Are you really arguing that this is just par for the course at this point?
Well, if you look over the last 10 years, there's been a series of regulatory tightening policies in China, across a number of different sectors. Each time that sector gets hit, 20 to 50%. So I think that what we're seeing now is, it's extreme volatility, of course, but, we're also seeing some signs of bottom fishing. The K-Web ETF has taken in $2 billion of inflows over the last month. I think there's, some people that are looking at, value in the internet sector.
Yeah. Perth, what about that argument? Can China be investable as a value play, as John has been implying?
Yeah, I think the fact that China is now being seen as a value play is a testament to how much we underestimated the risks and how people are now repricing that risk. I mean, let's be clear. I mean, China had a lot of growth over the last 30 years. That's undeniable. But that growth came from an increase in freedom levels. The government stepped back and allowed people to be more free. And that caused this tremendous growth in the country. And if they do that again, then absolutely it's a value play. But right now, that regulatory risk is going the other direction and going the other direction fast. And that pendulum is swinging the other way. You see their favored sectors like tech getting hit hard. And that's just not something we've ever seen before. This government is going to be in place for a long time unless there's some upheaval and the crisis that kind of overthrows them. And so this is not a place where we want to be investing. We don't want to give up the opportunity risk of all the other emerging markets that have the conditions on the ground for growth and wealth creation and have free people and free markets. So we're not going to give up that growth. I mean, if you look at China in the past, right, last 10 years, let's look at something large cap like FXI. That fund has returned about 25% over the last 10 years cumulatively. Compare that to their neighboring markets. South Korea has returned twice that. Taiwan has returned 170% in that time period. So I think China, yes, they've had some growth in the past. That growth was due to the government stepping back. Now you see the government going the other direction, and that is now a growth story of the past.
Yeah, and so you're invested in big, global, mostly tech companies outside of China. I see Taiwan Semi, obviously in Taiwan, Samsung, MediaTek, Honhai Precision, another company that's based in Taiwan. So your argument is still stay away from China, and that you can get just as much, if not better, growth by investing in companies outside of there that are more freedom weighted, as you like to argue. There's your weightings here by country, and you can see there's obviously nothing in mainland China.
Yeah, absolutely. So we believe that growth in the next decade is to be found in countries that are more free in the emerging markets. Yes, they're going to do trade with China, and we don't penalize free trade. Trade is good, and that's part of their economic freedom. But these are not companies that answer to the Chinese state. These are not companies where the state can come in overnight and wipe out all of your value because you're now required to be a nonprofit, like we saw with the edutech companies last week. So this is not a tail risk that we're willing to take, and freedom weighting solves that problem and eliminates that risk for investors. You're still going to have some indirect China exposure through trade, and you'll have that even in the S&P 500. But there's no need to double up on that.
So, Kevin, what do you say to Perth's argument at this point? They're all essentially state-owned enterprises. Is Alibaba or JD.com essentially a state-owned enterprise? I mean, I've heard Perth say before, whatever happened to Jack Ma? I mean, is he a state-owned enterprise? I'm not being rhetorical, but
no.
You get where she's going with this.
I understand, but these are sensationalist comments and thoughts. The idea that China's done well because they gave people freedom and they had capitalism for the last 30 years, and now they're going to change it. I think it's that type of talk and the fear and panic that makes an incredible opportunity. The Chinese government understands capitalism. I'm with Charlie Munger and Ray Dalio on this. They know that if people make money, that's good for the country, and they'll continue to allow that. And this series of regulatory issues is just normal management of the country. It's the financial system, it's monopoly rules, and these are not unique to China. Every day you can see the similar attacks here in the U.S. on our big tech companies. In Europe, it seems like every month Google pays billions of dollars in fines. So this is about government getting its arms around the power that a lot of these technology companies have and making sure that they have rules and regulations in place that are for the good of society.
Yeah, Perth, is this going to discourage people from investing outside the United States in general? Is this good or bad news? I mean, we've talked about how the international investor in general has been on their heels for the last 10 years. They're going to be even more on their heels defending themselves about being invested overseas. Is there anything good or bad that comes out of this?
Yeah, unfortunately, I think this would encourage investors to turn negative sentiment toward international investing, especially emerging markets, because these are the very issues why people don't invest in emerging markets in the first place, the lack of transparency and the political risk. We try to eliminate that risk by doing freedom weighting. And so I think we do solve that problem for investors. But absolutely, especially in a time when U.S. valuations are so high, you don't want to be discouraging people from investing in overseas. So unfortunately, I think that is what's going to happen here, especially since China makes up 40% of most emerging market indexes.
So, John, does this regulatory thing with China regulators and U.S. regulators sort of upend global investing? You and I have been doing this for a long time. For the last 15 years, we keep talking about the U.S. consumer is allocating more money to investing overseas. It's easier to do because of ETFs and the growth of indexing. So you sit there and you say, okay, if I'm in the all-world, index, China is 5%, and I can buy that as an ETF easily. If I'm in an emerging market index, China might be 40%, including Hong Kong and part of China. And everybody just said, okay, that's the way the world works. Does this upend any of that? Does this say, well, maybe we should not think about investing globally by market capitalization. We ought to think about it in another way. I'm just thinking if there's something happening that's a sea change, or perhaps, as he is suggesting, maybe it's much ado about nothing. Maybe we've seen this regulatory crackdown before, and we ought to just keep continuing investing in. I'm trying to figure out, what should the investor be thinking about this? Should they change the way they're investing?
Well, I think, the last 10 years, you've had an incredible run in U.S. markets. The rest of the world has underperformed. U.S. is a higher quality market. It's got better balance sheets. It's got better fundamentals. There's periods of time where emerging markets or developed markets will outperform. I think investors and other financial advisors have been very discouraged over the last 10 years because you've had a one-way trade where it's been mostly U.S. outperformance. I still think the right thing to do is to have a globally diversified portfolio and have some exposures to emerging markets and China and other developed markets. I know it's tough, but you really want to have a long-term, time horizon.
Yeah, and I know we were talking before. Kathy Wood is reducing, of course, of ARK is reducing her exposure to China stocks. And then there was an announcement just this weekend. There's a short ARK ETF filing. You can actually be able to short that. What does that portend for thematic investing when you can get a short ARK ETF filing?
Well, first, I'm a big fan of Kathy Woods. I think she's done an incredible job for the active management industry. I see a lot of Me Too products, people trying to replicate her success. So definitely pulling for her. What I would say is that I think all investors should have the ability to hedge their exposures. So there's like $2.5 billion of short interest in the ARK-K ETF. And if you're a traditional investor, you're going to go on Schwab or TD and try and short, you're going to pay probably exorbitant borrow costs and fees. So to be able to have an inverse ETF, I think it's a good thing. ProShares Direction have done a pretty good job, over 10, 15 years in terms of leveraging inverse products. So I think it's a good tool for people to have in their toolkit.
Kevin, I just want to go back to the idea of how tough it is to be a global investor at this point. If you're an international fund advisor, you've been underperforming for 10 years now. I just put up some statistics. The S&P is up 240% in the last 10 years. Even Japan's only up 180%. MCHI, the main China ETF, is up 35%. The EEM, one of the largest emerging markets, essentially flat, it's up 7%. That's a tough. Every year, you're basically saying, "Why am I allocating internationally and I'm behind?" And now you have this additional factor.
Well, there's no doubt. Look, emerging markets have been a huge disappointment. The 14-year return for emerging markets is basically zero, and with a lot of red in the middle of just getting your money back. But you don't, in emerging markets, you can't buy the broad indexes. The broad indexes are broken because of heavy exposure to the legacy economy. They're the exposure to the state-owned banks, the oil companies, the corruption. People are talking about the risks of China the last two presidents of Brazil are in prison for basically stealing your money
Petrobras.
if you're using EEM or VWO. And so what we've done is create really the tip of the spear, not just of growth in emerging markets, but in the entire world. I mean, this is the fastest growing sector, I think, by far in the world. And investors in this particular sector have done very well. Especially relative to every other emerging market flavor.
Perth, Kevin does bring up a good point. You might have freedom in many countries of the world. In theory, you have it in Brazil, too, but you can get just as much corruption and people stealing money. You keep bringing up Petrobras. I know, look what happened to that company, where companies people came in and, is it too strong a word to say looted the company?
It's exactly what they did. And it was the last two presidents and about a third of their congresspeople were systematically stealing billions of dollars from Petrobras and thus people that own the Vanguard and Schwab funds.
And yet, Perth, there's a reason for us to continue to support freedom and liberty because, well, look here, as John likes to say, quality. Why are we the highest quality market in the world, John? Because of the way we conduct capitalism? What is it makes the U.S. such a high quality return?
Better balance sheets, better regulatory framework, more clarity in data. Just historically the way U.S. companies have been run relative to the rest of the world. So
Perth,
that's why you'll pay a premium in terms of valuation, and that's why it'll tend to be richer compared to emerging markets.
So Perth, I'm going to leave you with the last word. How do we get the rest of the world to be the same high quality and have the same high quality metrics that John is talking about? What's the right path?
Yeah, I think John is exactly right. It's our rule of law that allows us to be a successful capitalist marketplace. And without that rule of law, you just cannot operate efficiently. So we're talking about things like corruption. Corruption and freedom are inversely correlated, and there's a direct, observable, positive inverse correlation with those two things. And so if you're going to try to avoid the companies that cannot operate efficiently because they have to put state interests first, and if the state is corrupt, then there's nothing you can do. So we're going to try to avoid those companies, and we're going to try to invest in the places that have the freedom to operate in the best interest of shareholders and other stakeholders besides the government. And we think that's where the growth is going to be in the next few years. And I'm glad that Kevin got to ride the Archegos bubble there. But I think it's time to switch into other emerging markets. And fortunately, his fund is an emerging markets fund, not a China fund. So he's able to do that. So I think we'll all be successful here going forward.
Okay, very well said. And we can always count on you to bring out the fundamentals of the capitalist system that we all believe in. Perth, thanks very much. And that's it for this week's ETF Edge. My thanks to Perth and to Kevin and to John. And we've asked Kevin to stick around and chat a bit more about China investing for our ETF Edge podcast. Remember, you can see all of our shows on the website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.